All right. So with that, certainly want to just reiterate, think about those first-time home buyer products that we covered. If there's some solutions, you want to explore more products and how that would work, we would love to set up a time to talk with you about that. And I'm going to go ahead and turn things over to Kat at LoanSense.
Yep.
There you go. It's loading your presentation.
Thank you.
Okay.
Awesome. Okay, loading presentation here. Okay, great. Thank you all so much. To get on the trivia train, I will certainly get on the trivia train because I love that. First and foremost, let me tell my story a bit because it's very relevant to this work. Because people always wonder, how do student loans have to do with mortgage? I, in 2015, was declined for my first mortgage, and I was declined. I went to 3 different lenders, including my credit union. Like I said, I bank at credit unions. And the third loan officer that actually called me back said, pay down your student loans and come back later. That was the response I got. The other 2 I never heard from. And I thought to myself right away, how long do I eat ramen for? How much will this house be worth? Will I be able to afford it when I'm done eating ramen for that many years, right? And I started researching myself and found out that Freddie and Fannie, and at the time I didn't know anything about Freddie Fannie agencies. I just heard that I can change student loan plans. And I closed on my first house 45 days later. And that's so important because the National Association of Realtors started blitzing the news about 3 years after my experience, essentially saying, hey, it's the number one it's holding the majority of our generation back. It's the number one issues for millennials. It's deferring down payment savings and it's impacting debt to income. It's going to be a rising issue that the industry needs to pay attention to. So my story is representative of 30 to 40% of your first time buyer membership base. So as Dawn and Denise talked a little bit about, how Fannie is offering $2,500, there's some free sources of money out there. Down payment assistance, Fannie's $2,500, and student loan repayment assistance through the federal government. These programs already exist. They exist through the Department of Education. If a borrower cannot afford to pay their fully amortized payment, they can get into an income-driven plan. They can get into a loan forgiveness pathway. They can even qualify for discharge if they went to a for-profit school. If they're a public servant, a first responder, there's all kinds of specific programs, even for teachers, for healthcare workers. They can get a lower payment and not just kicking the can down the road. It's actually qualifying them for forms of loan forgiveness. And by enrolling in these programs, it is Freddie, Fannie, FHA, VA guideline compliant to close on a mortgage with a lower student loan payment in 21 days. Okay. That's what we do here at LoanSense. We help you all as credit unions identify opportunities for your membership base, right? We talk about life event changes, graduation. You're going to have a cash flow problem if all of a sudden you went from not having to pay something to now having a $500, $600 payment a month. Cash flow issues. How do we help our membership manage that? LoanSense can help identify members we can help. And as a result, reduce that payment by enrolling into federal programs. We do all the paperwork filing for them. We alert the assigned representative, whether it's a member advocate on your all side, of who we can help, by how much, and as a result, save that loan, right? So I want to ask a trivia question myself. What do you think is the average payoff for a student loan borrower on average? What do you think the average age of payoff for a student loan borrower is when they're done paying off their loans? Can we type? What are the guesses here? I want to see what the guesses are here.
I'm interested in the answer. That's interesting for sure. It's got to be astronomical.
Me too. I'm guessing.
Okay, let me try to see if I could see the question. The questions.
I think they're a mix in chat.
Oh, look! Yeah. Okay. So people, it's very interesting. I see 70 years old. Oh my gosh. Okay. The average national payoff. I'm not talking about Parent Plus loans because that's different. I'm talking about regular loans of a person going themselves. It's actually 43 years old. So Devin, you guessed exactly.
Devin nailed it. Wow.
Devin.
43 years old. But here's the craziest trend. Those in their 50s are actually taking out the highest balances in Parent Plus loans. That's the craziest trend. So it's not just an impact to borrowers who are first-time borrowers, now it's an impact also to your membership who may be considering retirement. So really quick stats, 45 million of us, those in their 30s, hold 40% of all debt, literally about over 800 billion in student loan debt is held by those in their 30s. Average payoff, 43 years old. It's deferring home ownership by about 5 years. And it specifically impacts Black Americans who take out 20 to 30% more for the same degrees. And of course, it definitely in the mortgage process highly impacts low to moderate income borrowers because they hold similar amounts of debt and have lower earnings. So literally, we did a market study with one of the GSEs. We could improve access for 10% of minority and LMI borrowers if we address this problem systematically. So we're here to talk about that. LoanSense, we service over 2,000 people in our software from 100 different lenders. We started onboarding credit unions recently. We're super excited, and we have a partnership with a GSE, and it's really important that we have partnerships with GSEs because we want to influence the way that GSEs recognize student loans in the guidelines so that we can help more student loan borrowers and your members with student loans close on a home. So I want to take a really quick opportunity to do a mortgage pipeline exercise, and it really much aligns with what Denise and Dawn were talking about. It's going to be a pretty quick exercise. If you all are interested in doing this for your credit union, we can share an actual spreadsheet with you so you can enter your own numbers so that the end product is so you understand what is it costing you to originate a mortgage. We talk about a lot of reasons that people are dropping out of this mortgage pipeline, right? I love what Denise covered. And it's really important to understand that because if you understand the number one reason, if it has anything to do with a process you all can improve, it's important that you improve it because it will help with pull through. And for every loan you can pull through from 100 applications, it reduces your cost to originate. And Denise talked about, right, the cost to originate being over $12,000. So every time we can reduce the cost to originate, it's adding so much value, right? So if you don't know these numbers, please jot down these questions or ask questions because it's important to bring back some of these questions so that you can understand what is it costing us, what can we do to improve it, right? How many members come into your mortgage pipeline each month, right? What percentage do you pull credit and or take applications on? Sometimes it's flip-flop. Sometimes credit unions will take applications, then pull credit or pull soft, then take an application, then hard, right? So I recognize it might be different at different credit unions. They might do different processes, but what's a percentage of people that you finally get a full app from the people you engage up front? And then finally, what is the percent that you're originating for from full application? And what is your highest and leading reason for decline? And knowing this is really important because historically it's been credit, but right now it's high debt to income. Since the pandemic, Americans are taking on so much consumer debt, and it's now the leading reason for decline. So are there solutions you could put in place? Like, is there a consolidation loan product to help with high interest credit card that can now help the member become mortgage ready sooner, right? What's the leading reason for decline that you can help your member get over the hump so that there's fewer reasons why you have to decline a member for a home, right? So I like to put that out there because it's not just mid-funnel, but it's higher funnel. So quick thought process. If you take in and you have 200 leads or 200 conversations to get 100 applications or 100 credit pulls and you get 50 to 60 applications, and somebody at your credit union is spending time or you're spending digital marketing resources, and let's say it costs $50, that's $10,000 to engage with 200 members to ultimately get 50 to 60 applications in this example that I use. And let's say 12 end up originating and you decline 38 to 48 people on average a month. I'm just using 100 credit pulls just to use a round number. And let's say 24 are due to high debt to income because, again, leading reason for decline, high DTI, right? Knowing these numbers, again, super important to improving your processes, but also understanding why decline is happening and what can you do in the middle of the funnel, what Dawn talked about, so that we can repair, right? So for perspective, I wanted to talk about how LoanSense addresses this a bit. So out of 100 credit pulls and or start of the process, we have all kinds of marketing assets to talk to members with student loan debt. We also have even calculators that credit unions could put on their website with two numbers, estimate the reduction in student loans and improve home affordability, right? And out of these 100 applications in our credit pools, you're going to get 30 to 45 with student debt. So why is this valuable? Because if they're going to rate shop you, and LoanSense can not just, LoanSense can help identify the people that we can boost affordability. So what we do here at LoanSense is, on average, we're improving affordability by 50 to 80,000, depending on the state, in 21 days for those with student debt. And so we're improving it by reducing the student debt, improving the debt to income, and we're boosting affordability by $50,000 to $80,000. That will help stop people with student debt from rate shopping, because it's not just about the rate, it's about improved affordability in the market that they're in. And then for these 30 to 45 people, 10 to 20 will have a significant improvement, meaning we can take them from above a 45 debt to income to under 45 debt to income, or they can save $100+ on their student loans. Those are opportunities we immediately identify for your loan officers or member advocates so that we can help pull through your member and help them with their student loan. So in this pipeline, what LoanSense always strives to do is add 10 people to the middle of the funnel to help you originate 2 more in your pipeline and save 3 from decline. So if you originate 5 more loans out of 100 applications, that will literally reduce your cost to originate by about $245 a member. Again, I have this spreadsheet so you can even enter your own numbers and understand what it is to look at your cost to originate and see where you can make improvements in your pipeline. If you're servicing, we can help identify members that can improve DTI, and you can offer cash out HELOC offers to, and of course help prevent decline if they lose their job, can't pay their student loan, and they're at a risk of default and they have student loans. We can get them in a $0 program that's not forbearance that can help them continue to pay their mortgage. I have one more slide and then I will be over, because I definitely want to leave time for questions. So a credit union in the Midwest sent us through the data in their pipeline, we saw 136 people with student debt. 35 of them got significant savings, which means we improved the debt to income, qualified them, or saved at least $150. That's 26% of their members that we identified to help them save and send a communication directly to their assigned loan officer to help pull them through. A national lender here, in 3 months, we're able to help them with 89 clients, improve affordability by $71,000, and the average savings we achieved was $526 for their borrowers. Here's a sample communication. We automatically alert the assigned representative at the credit union when we can help that member in the loan process improve their affordability. So I'm coming to the end of my presentation, but I invite anybody who would like to look at their pipeline or even have high level on the number of credit pulls, understand how many loans that they can help save and how many members they can help. Happy to talk through it. You're welcome to chat if you're interested in getting the spreadsheet, chat your information, or also email us. Here's our contact, sales@myLoanSense, and our phone number. And I will turn.
Perfect. Here's one for Kat. What do you do with the student loans for the member?
So what we do is we'll identify them for the credit union and your member advocate, and then we provide a link to the member. They will come through a member-facing part of our portal, answer some questions, we'll connect their loans and enroll all their student loan paperwork like a TurboTax. We'll qualify them for income-driven, public service loan forgiveness, whatever they qualify, and we will get the guideline-compliant docs, Freddie, Fannie, FHA, VA guideline-compliant docs to close in the 21-day period and share it with the loan officer as well.
Perfect.